Investors this week are going to start focusing on quarterly results from the key retailers, places like Home Depot, Lowe's, and Target. Those should provide an updated look at consumer spending. Joining us right now to talk about what's ahead, the impact of the Moody's U.S. credit downgrade, is Lori Calvasina. She is head of U.S. equity strategy at RBC Capital Markets. And Lori, let's just talk about this downgrade.
Yeah.
What this means, the market's reacting, and I think if you look at the big tech stocks, they're taking it particularly hard.
Yeah.
Those are the stocks that last week looked like the safest place to be. This week, questions again, because if you have interest rates going up from here, those will be some of the places that suffer.
Right. And look, I think anytime there's this sort of sell the USA trade mentality, frankly, overseas investors wanting to pull money out of the U.S., that's a part of the market that gets hit hard. And when I think about just my client meetings over the last couple of years, every time I go to Europe, that's all they want to talk about. Mag 7, growth versus value. And to the extent, we're sort of seeing that emphasis on kind of dialing down U.S. exposure, it just hits those places harder because of the math and because of that interest. They have bought this market for growth, and so that suffers when they don't want to buy this market anymore.
How big of a deal is the Moody's downgrade? It's the third of the major ratings agencies to do this. It's far behind what we saw with both S&P and Fitch. But it does come at a moment in time when the Treasury markets have been a little more focused on debt and deficit.
Right. So from my seat in U.S. equity strategy, what I care about is the bond market reaction.
Right.
And, it's up to those folks to sort of say what those implications are. I think most of them would probably tell you mechanically there's not a ton of importance here. This is more symbolic. But at the same time, if it's going to push 10-year Treasury yields up, my market is going to care because that impacts valuation multiples. It impacts debt, right? Interest expense and those sorts of things. If you also look back to 2023, we had a big move up in 10-year Treasury yields. That was not all about the downgrade that happened at that point in time. In fact, I'm told that it really was largely about other things. But we did still see a 10% downward move when you saw the 10-year Treasury approach 5%. The other thing I'll tell you, Becky, is I was sort of going through, my own process over the weekend. There were kind of two things that came to mind. One, my earnings yield gap model, stocks versus bonds. Mm-hmm. If you hit 5% and start to creep above it, you enter in a range that's not favorable for stocks historically anymore.
Right, because people would rather take the risk-free treasuries.
Exactly. And we've been in a favorable environment. 4.5% we can handle. But if you start to creep up to 5%, people are going to start to get nervous on that front. The other thing is, frankly, we're all sitting here a week ago. We had this big China news. We had this really, kind of a step up in terms of economic expectations because of that step down in the China tariff situation. That got priced in a day. Right. And, when I run through my valuation modeling, we're about where we should be, maybe a little over our skis based on that better fundamental outlook. And so now where are we? Well, we've processed all this good news. We're starting to get bad news. And that's really how I think about this Moody's downgrade, is in the context of that headline risk. It's too many tariff headlines over the weekend to even count, but they weren't as good as what we saw last weekend. Let's just leave it at that. And then you have sort of the tax bill, and I know it progressed last night, but was starting to stall late last week. So it's almost like this bad news is coming out like cockroaches. There's not just one thing, and it's coming at a time when we're a little over our skis.
Well, that's what I was going to say. Price is probably everything if you're looking at valuations here. We dropped 15% in the S&P in 3 days after April 2nd when the tariffs were first announced. We are back up something like 23% from there. So you're only within a percentage point or two from the S&P's all-time highs. And that makes everything look a little different.
The other thing I noticed, we go through every Friday just all of our weekly models, and one of the things that we said back in early April, so the day after, or a day or two after Liberation Day, we actually downgraded our target, and we got some pushback. People said we didn't cut enough, and we came back and said, the fundamental outlook doesn't look so great here, but sentiment is so lousy, you look for those rebound trades. Well, last week, the AAII net bull bear indicator rose pretty sharply and is now about 1 standard deviation below the long-term average. It's a really favorable setup for stocks when you were down at 2 standard deviations, but we're rapidly sort of exiting that kind of sweet spot, contrarian, hold your nose and buy type opportunity. Not in a bad spot yet, but we've done a lot of the recovery.